Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about how your retirement asset allocation could be costing you unnecessary taxes. More specifically, we're going to be talking about how two individuals with exactly the same asset allocation, where one person could be paying significantly more in taxes just because of how they position their investments. So if you've watched some of my other videos, we've been talking a lot about taxes here lately. It's one of the 7 core elements of retirement planning, maybe one of the biggest ones to understand as you go into retirement. We've also talked a little bit about what we call the 3 primary tax buckets as you're starting to save money for retirement and as you start taking money out of those accounts for retirement. The first one over here on the left is what we call the non-retirement bucket. It's really the one that kind of has the most unique set of rules as it pertains to taxes. So the non-retirement bucket, just to refresh you, that's the one where you get that 1099 form every year. You got to pay taxes on all the gains, the interest, and the dividends that that account creates on a year-to-year basis. So let's talk about some of the rules there. So number one is if you have long-term capital gains, there's actually some special tax treatment that you get from that. For most people probably watching this video, those long-term capital gains are going to be taxed at 15%. If you're one of the higher tax brackets, that 15% could go up to 20%. You could get hit with a Medicare surtax, but that's up at higher income levels there generally. You could have short-term capital gains, and that's going to be taxed at your ordinary income tax rate. That's something to remember because your ordinary income tax rate is going to be the rate that you're going to be paying the highest taxes on. So we're going to talk about that a little bit more here in a bit. Dividends are another one. Qualified dividends in particular, and we'll write that one down here, qualified dividends. That also has a 15% preferential tax treatment for most people. You could have municipal bonds, and if they're muni bonds, then generally speaking, you're not paying any taxes on that. And then the big one that I want to focus on here is interest, and interest income from maybe CDs or bonds. That is going to be taxed at your ordinary income tax rate. So if we think about this, what we want to do is, obviously there's certain classifications of income that's going to be better to have in this account than others. So we don't generally want to have interest income in this account if we can avoid it. And we also don't want to have, I didn't write it down here, but go back to this short-term capital gains. That's also going to be at your ordinary income tax bracket. So those are the 2 that we generally want to avoid. Now let's talk about the other 2 buckets here. So your traditional bucket is maybe IRA or 401k accounts. That money generally goes into that account on a pre-tax basis, so you didn't pay any money on that contribution as the money went in, but you will pay taxes on that money as it comes out in retirement. And that also is going to be taxed at your ordinary income tax bucket. And then finally, the Roth bucket is money that you pay taxes on that money before it goes into the Roth, but as it comes out, as long as it's a qualified withdrawal, it's going to be tax-free. So if we start to think about this and how we want to build our asset allocation, and let's just say that we're talking about a 60-40 retirement asset allocation that almost everybody talks about, where maybe 60% of your assets are in stocks and 40% of your assets are in bonds. What's the best place to do that? Well, we've talked in some of our other videos about how to shift this money around to get more money in some of these tax advantage. So again, that's not what we're going to talk about here today, but we're going to get into what types of investments we want to do. Well, let's start over here with the Roth bucket. And again, because that's going to be tax-free, anything that grows in that bucket can come out completely tax-free. Generally speaking, we want to look at putting your most aggressive investments into that Roth bucket, because the more that account grows, the bigger the tax advantage of that account is generally going to be, either for you or maybe even for your kids or your grandkids if that money eventually is going to get passed down to them. Your traditional retirement account, if we're looking at having, aggressive things over here, maybe we want to have a little bit less aggressive things over here in the traditional bucket, because as that account grows, the more it grows, the more money you're going to have to pay in taxes on that account, and the more money your kids or grandkids would have to pay in taxes in there. So we want to maybe look at, in this bucket, maybe some of those things that would generally be our are worst for the non-retirement account bucket, like that interest income. Maybe we want to have a little bit more of that interest income over here in the traditional bucket, and that would reduce that. You're paying ordinary income taxes on that anyway, so you want to think about that. And then finally over here, we want to focus on, generally speaking, things that are going to be at that preferential tax treatment. So if you have a portfolio of high quality stocks that have good dividends that are going to be taxed at that 15% rate, that's a good category to have over here in the non-retirement bucket. Municipal bonds, of course, for some people that might make sense as well. And then things that you are going to generally buy and hold. So long-term capital gains where you're not doing a lot of buying and selling. That's another preferential item over here where we want to have more things there in that long-term capital gains bucket. One other thing that I want to note here about that in terms of capital gains is that if you hold on to something, maybe you have a stock that you like or an index that you like, and you hold on to that and it's at a substantial gain and you pass away with that stock in your portfolio, your kids or your grandkids or whoever's inheriting that money get what's called a step up in cost basis. So let's say you got lucky and you bought Apple stock at a really low price and it goes up and you pass away with that stock. Your kids would inherit that Apple stock as if they had bought it at the date of your death. So all of that capital gain completely gets erased as it pertains to the tax laws today. So that's what I wanted to point out here in this video, is let you think about this a little bit differently and think about the categories of investments and where to maybe place some of those investments within these three primary tax buckets. So anyway, I hope you got some value out of this video. If you like, we have a video where I go into a lot more detail on how to create a tax plan for your retirement. It's on our free resources section at moneyevolution.com. We'll put a link to it below the video here today. And hopefully you like the value that we're providing here with these videos. If you do, make sure you hit that like or subscribe button and make some comments or give us some notes and feedback on how you like the videos, and we'll see you back in one of our future videos. Thanks. Have a great day.